This episode will look at Indonesia taking a firm grip on coal exports, further belt tightening measures in Southeast Asia as oil prices stay high, Indian Prime Minister Modi winding down fuel subsidies, and a contrarian view on forecast of a stock market correction. Hello to our listeners. I'm Mel Lopez, Chief Economist for ASEAN.
And I'm Peter Lundgren, the founding CEO of Lundgren's Capital.
This is Sound Economies with Mel and Peter, a weekly East meets West podcast by Lundgren's Investor Insights. Join us as we analyze developments in major economies and financial markets globally.
Hi Mel, how are you today? And how's the week so far?
Yes, Peter. So actually, a lot of news developments going on here in the Philippines and of course across the region. Very interesting, ranging from some chaos in Philippine politics. And of course, the Trump-Xi summit just concluded last Friday. So I have been spending the last few days trying to look for cues that we are always watchful about. So now apparently Putin is in Beijing. So I remember the story of the Boeing, and yeah, it's a very, very interesting scene here in Asia right now. How about you, Peter? How are you at the office this week?
Yeah, it's as you mentioned, we do spend more time together on the market, they move and take attention. But that's fine. It's part of our job and how it is now and then. And then we have good focus on our defense fund again. Actually, yesterday we had a really good webinar with a huge US-based asset manager called American Century, where we tuned in on how they use and work with ETFs. As they conclude, it's not just straightforward. An ETF is not necessarily just a tracker. There can be very different things in the ETF. Even we believe it's a tracker, but also how to build bias into that market. And that was pretty interesting, actually. A lot of different things. Also today we will conclude that things are on the move. Yeah. Let's simply start, and to no surprise, we will start in Asia, for a neighbor country in Indonesia. It's almost an
Favorite?
running yeah, same here. And
Yeah.
they do a lot of things. Yeah, so
We do say that we like the growth, the rapid growth here in Southeast Asia. But as of the past few months, we have been looking cautiously towards Indonesia. So it's looking like a series of unsound policies coming out from Jakarta. Well, Nusantara now, if we follow the new capital. And they have recently, just yesterday actually, just announced a new proposal or policy to restrict exports of coal, palm oil, and iron alloy. So it's looking like their favorite trade policy as of late. If Trump likes his tariffs high, Indonesia likes to restrict the shipments of metals and natural resources that's coming out of Indonesia. It follows the relative success of their or export ban for nickel a couple of years back. So they're trying to replicate the success, given that Indonesia is also the biggest global exporter of coal and palm oil. They're trying to hit multiple goals in one go. So, of course, they want to shore up additional revenues coming from essentially higher prices as they restrict volumes of exports of these materials. They're also trying to curb under invoicing or like tax misdeclarations with these shipments. And they're also trying to save or recover the value of the rupiah, which is another different goal altogether. And it is the way they're planning to do this is they're telling every producer middleman of coal and palm oil to essentially sell their supplies to a state enterprise, a state agency. Right now it's going to be the Danantara sovereign fund. So they're going to essentially buy these supplies from all local producers, and then foreign buyers will have to talk to Danantara, and that's the way they're gonna control prices, shipments, and the revenues and the customs duties that come with it. So we do not like export controls. We have been very vocal about it. It's another way of government intervention on what should be market-driven price dynamics. So we do not agree really. And this will actually further bloat energy prices artificially. So it has the same effect, albeit at a lower scale, as the ongoing US-Iran conflict. And it's also unhelpful at this time if you're trying to save, quote unquote, the rupiah, when it has to be as market oriented, as market driven as possible. So, and given Indonesia's reputational problems right now with their stock market, we have talked about this in the past episodes. MSCI has given penalties by removing Indonesian stocks from the global index. That is a much bigger factor. And we also just saw this week the report from Bloomberg that the Singapore Stock Exchange is actually now the biggest Southeast Asian stock market. It has overtaken the Jakarta Stock Exchange already because uh, stock valuations have become so depressed year to date. I think down 30%, if I remember the figure correctly. So it's adding this highly intrusive and potentially inefficient policy into the mix does not really bode well for Indonesia's prospects. We did also see a similar comment coming out from S&P Global Ratings just today. So the feeling or the sentiment is building, and it's not favorable towards Indonesia right now, Peter.
No, this is as you say, we take it. We actually take it very seriously. This is how you ruin the own economy, and all the government intervention in the private sector is as bad as it can get. Yeah, basically, it's just another reason to stay out of Indonesia's stock market for a time being, as we have sort of argued for a long time. But this is also how a country can start a currency crisis. We don't see any sort of immediate risk of this, if it should happen, that it will spread. It is a pretty isolated situation right now still for Indonesia, and how they choose to work around with the problems they have. Yeah, this is simply just a reason to say, okay, this is a no-go. We hope they will change their minds soon. Yeah, how they work with the challenges. But let's be honest, Mel, as Southeast Asia is sort of the region we see the highest growth opportunities, and where things can reach and come into the highs, they can also easily sort of be a bit towards the lows. Yeah, it is a bit what we see right now. It is a bit of squeeze, and now Thailand has for some time been squeezed on that is particular sort of the private consumption. Yeah, a
Yeah.
bit in the same in Philippines. People are holding back. Maybe not necessarily as sort of a crisis like in
Mhm.
Thailand. Yeah, what do we see there right now?
Actually, in general, Peter, the trend is really towards belt tightening measures. Here in the Philippines, I think we took a relatively different approach as our neighbors. The likes of Indonesia, Malaysia had been, or even Thailand had been giving out fuel subsidies and like discounts by subsidizing the pump price for so since
Uh,
March when oil prices went up. In the Philippines, we didn't really do that. The response has been on the demand side, and that's what they're trying to do. And the resulting trend right now is there is increasingly that fear that we're gonna proceed towards stagflation. So it was easy to see coming out from the Q1 GDP data, from a growth of like 5%, 4.5%, we're at 2.8% in Q1, and inflation is the reverse of that. It was 7.2 in April. So very alarming. And the president of the country is taking notice. And apart from the demand reduction measures, we talked about this before, like 4-day work weeks in government, encouraging offices to like do remote work and totally shut down like power in that building for a day just to, reduce demand for power. We are in the middle of summer as well, so demand for electricity is higher because we need to keep ourselves cool. And yeah, so they're trying to do that. And the latest pronouncement is to the president has told all government agencies to reduce maintenance and operational spending by at least 10% to the
Mm,
load demand. Basically, yeah, it sounds good, but at the same time, that will further reduce consumption or government spending. So it will also work towards reduce growth even more. So it is quite a
mm,
bind. And if we compare, but I think I would personally prefer that as a strategy rather than Thailand. Thailand is trying to, or it has pursued fresh loans just to provide subsidies, direct subsidies to consumers. They call it Thai Help Thai program. So they're gonna give each uh, low to middle income citizen about 1,000 baht per month for 4 months. So that will all cost about $6 billion for another round of consumer subsidies. And it is
yeah,
such a big bill for for Thailand to pay at the time when everything is expensive already. It's hard to encourage Thai households to
mm,
spend because they are in principle heavily
yeah,
in debt. So the reluctance to spend has been there even way before this crisis in oil. So it is.
mm.
I'm not so sure it's the best approach either. Um, Especially when the US Iran conflict is out of Southeast Asia's hands because yeah, we are bearing the brunt of it because we are among the biggest importers of oil, but at the same time it's not looking like the end is in sight. So i- doing these subsidies, although it would benefit consumers in the short term, it sounds to be unsustainable.
Also in Thailand, it's a bit long-term fight, yeah, to just to secure some
Yes.
household spending. And as you
Yes.
say, it's actually pretty expensive. It's not really kickstarting anything. It's just it's more repairing a hole. Yeah. So no doubt that there is a squeeze here and there. But on the other side, as Indonesia and Thailand is probably the two economies we see as sort of the most hurt. Yeah.
Yes,
So,
definitely.
but maybe what is a bit as let's basically stay in the Asian region, but
Mhm.
move a bit towards west to India, and it's what's surprising there is a very tough wording from Moody,
Yes.
the minister. It's rare to
Yeah.
to to observe a country head coming out with almost this sort of preparing people for a shock. Yeah? So he is obviously, or his government is obviously concerned about the ongoing or higher oil price that it will hurt India because they are very dependent on foreign import of energy and oil energy in general. Yeah. Is he too downbeat? Also, is he too negative? Also, where are we?
I think it was a case of either, some too optimistic forecasts that the US Iran conflict will resolve in maybe a month or two, but now we're on month 3 already. That's why they're running out of gas, as literally and figuratively, as far as subsidizing pump prices, which is why
Yeah,
um basically his message is like, I'm sorry guys, I really tried to cushion the blow, but it's becoming stretching on for longer, and it's not affordable anymore for the government to do that because literally they're also burning through the people's money in that
yeah.
way as well. So I think it's a more sober approach. It will hurt, but at least it has been postponed in a way that it didn't start pump prices did not start soaring in March. Maybe it will beginning
Yeah.
this time. There's
Yeah.
been already two rounds of pump price increases, which is probably surprising to Indians who were so used to relatively cheap oil. But at the same time,
Yeah.
they've had like 2 months to like see the news, see how it has not
Yeah.
developed
Yeah.
positively as far as the negotiation. So I think it does sound downbeat, but at the same time, consumers were given like time to process it, to mentally and
Mm.
financially prepare for it, if you will. So it is a good approach. I would rather that this be done in a in good communication rather than just drop it all together and say, okay, bye, no more subsidies for you. So that was, I think, that is a good way to manage the blow.
Sort of almost surprised about sort
Yeah.
of how tough the rhetoric is from the Indian government or Modi. Um, we fully recognize when as I mentioned, the swings up and down are bigger in many markets, Southeast Asia. But it's not necessarily that they are falling out of the bed, the stock markets,
Mhm.
as we probably would have seen for, let's say, 10 years ago. It's a different market and it's a different situation. There's much more allocation towards emerging markets, much more trust in the economies. And also, if we have a look at, let's say, the past 10 years, emerging market economies, they have got ratings upgrades. They are moving closer to to some of the European
Yes.
countries that, on the contrary, are sort of vulnerable to lose in the rating competition. So it's not as dangerous or volatile as it was before the
Right.
market. So we have the consideration say, okay, will the macro conditions, and we're talking about particularly about the oil price and the energy delivery situation, will it get worse? That's number one. Have we as a will the oil price go higher? And that's another story. Yeah, we could say let's wait and see, but
Yeah.
we might be sort of in the sort of the consideration say we are currently seeing the worst, maybe. Uh, at least we are sort of finding for the right timing actually to recommend to upgrade the holdings of, in particular, Southeast or Asia um, positions, using the current downbeat movements
Yeah.
and sort of feeling to increase the holdings more than anything else. Is it the right timing today? So on a 5 year horizon is fine, yeah. If we're looking for the exact right moment and say, okay, we want to have either
The
more prices
best.
downside, or we want to have a bit sort of at least some numbers just confirming there could be a turn towards the upside now.
Yes.
Um, yeah, so it might be not be the absolute perfect timing today, but we look into it. And this is actually our approach. It is more to say, okay, we believe there will be sort of
Mm-hmm.
a good opportunity. Yeah. So this is how we see it, but we fully recognize that economies right now they feel the pinch from the
Definitely.
high oil prices. Yeah,
Especially in
this
Asia,
is
yes.
basic. So this is how the world looks like. But anyway, another interesting issue, Mel, that we have on when we look into, let's say, just from a conviction model
Mm-hmm.
perspective, and the conviction model is sort of the disciplined approach where we try to follow the same model all the time to consider different sort of
Perspective.
features in the
Yeah.
market, expectations, whatever. And one of them is to say we have an opinion about something, but
Mm-hmm.
how is the opinion in the market about the same issue? And how strong is the conviction? How strong is our conviction? How strong is the market conviction about this and that? And here we now see interesting movements. Outright, we see an increasing number of people, market participants, articles, whatever, warning against the steep downwards correction in the stock market. We don't neglect these as a more and more people saying it.
Yeah.
On the other hand, if more and more people are saying so, but it doesn't happen, then that is actually important. That's very important for
Mhm.
investors to observe. Are we afraid of the downside? Yeah, we've talked about it since let's say before Christmas, November, December, that we could see this 15% downwards correction. We could not necessarily point out why, but we could just see typical dangers, rising interest rates. At that time, we didn't know that US would attack Iran. Of course, we
Yes.
had no chance to forecast that. But then other things would have happened, and we for sure, and we can repeat, we 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 are observant towards the rising government bond yields, as we
Yeah.
talked about last week. We are now at decade high levels.
Correct.
Because that can squeeze the stock market, or it can squeeze the economies. And what we don't like in the old economies is that the yields are not rising because of higher growth.
No.
This is simply not the key.
It's all
There is
fear.
yeah, there's an inflation risk fear. Yes, so far it's more linked to energy prices, and then we're not that nervous because it will settle one day. It will settle.
Yeah.
But we do notice a growing number of people talking about the steep downwards correction. But one of the most important pieces of data, or numbers, or whatever we call it, and that is outspoken in the US, that 85% of the companies, listed companies, has so far this year beaten their earnings forecast.
Mm-hmm.
And that is the most important indicator when, after all, looking into the stock market, into individual stocks.
For sure. Yeah.
Macroeconomic factors, they count. GDP growth count. Yes, it does.
Mm-hmm.
But the individual stock as a company performance is the most important, and they are performing. And this is a heavy argument actually for staying in the market. It's actually neglected that
Mm-hmm.
that we see, and it's particularly in the US. We need to say, okay, you're doing good actually. But it's a hard call to say that stocks will be sold extremely down if the companies are doing good. It's a tough call. If we look into Europe, it's where we see it as the weakest area, yeah, and it's where we say, okay, we underinvested. We have said that for 10 years. For us, this call for steep dives, so just the market falling out of the bed, that's a tough call. And we are seeing, okay, stocks are lower in
In the
some
database. Yeah.
markets and in far as Southeast Asia, compared to where they were when before US attacked Iran. The conflict escalated. But that is a sell-off we can explain. Yeah. And again, are stock markets holding okay on that base? Yeah, we would say it's okay. Yeah. So this is not a nervous market, and it's not a market that is sort of just extreme shaky. And that makes a downwards correction call very, very tough in terms of timing.
Mm-hmm.
Uh, so the people who are calling for, let's say, the market needs to drop 20%, one day they might be right, but it can be that the market goes up 25% before it drops 20. And this is
That's a
also in
different
line with
correction already.
it's just it's very tough call, and it's very
Yeah.
difficult and very difficult to reach. And as we said, also end of last year, we did point at our own predictions saying we could see a 15% correction, downwards correction. But would that mean we should go step out of the market or sell out and reduce the portfolio? No, because it is not enough actually to change yeah, the long-term position. It's always good to consider should we readjust the portfolio, not the overall allocation. Say, okay, yes, a lot of tech stocks has gone up and
Yeah.
they are sort of waiting a bit too much in the overall portfolio. Yes, make a shift, part of them sell a part and go into a bit more defensive, will not necessarily change your overall allocation. And this is basically the same here. So far, we are not afraid of all the negative guys out there. This is a message. Do we respect? Do we watch it? Do we consider? Yes, we do. But we haven't found the true arguments yet to say, okay, this is crashing, actually by
Yeah.
far. Yeah. So that is a bit sort of also a reflection and a respond on the growing number of people talking about
But
this big drop. Yeah.
mm-hmm.
So far, we are not by far not there. On the contrary, but there are swings out there. Yeah, and if we sort of take the usual next in the podcast step is to
Yes.
say, okay, so how much sunshine do we see sunshine at all out there? Well, how are we?
Definitely, Peter, there is still a lot of clouds in the horizon. It is dampening the mood, so to speak, especially for as everyone, especially the developing economies, feel the pinch from high inflation due to oil prices. But there are, of course, still drivers of growth, albeit it might be slower due to reduced consumption as prices go up. There remains to be sources of growth. We still like developing Asia and Southeast Asia in particular, though we are drawn to economies with better regulatory governance and more market friendly policies than others, as we discussed earlier today. Um,
Hmm?
yeah, but still, there's no doubt that there is a lot of growth opportunities here in Asia than, say, the mature economies.
Yeah, there's without any doubt the base case scenario that we run, but also I mentioned as we fully recognize there's less sunshine than there's been for, let's say, for 12 months ago.
Mm-hmm.
But that means in our terms that we need to consider, we need to take more care, we need to spend more time on the markets, we need to acknowledge it's more difficult to find the good and the right investments. It is not as easy as just buying something
Mm-hmm.
as it is in sort of the good times. Um, Again, we have moved a bit on when we looked into the fixed income market, saying, okay, it's more shorter durations. But on the other side, we still like the credit risk, meaning we're happy to keep positions in also emerging markets and corporate bonds,
Mm-hmm.
high yield bonds. We just prefer shorter durations due to the rising interest rate level. This is the way we adjust. And we are very happy about sort of the non-listed parts of the world. It is also where we see the biggest opportunities and actually see it as a stabilizing factor in a portfolio compared just to a plain listed stock portfolio. So,
Mm-hmm.
so this is where we are. That's how we see it. So actually, we remain pretty okay and see the world with in a positive way. Yeah. So this is our standing, despite of the many sort of uh, talk in different directions. Yes, well, so but interesting conversation, and thank you for sharing everything again this week, and also thank you to the many listeners out there. We'll be back next week.
Thank you.
Thank you for tuning in. As always, we keep a watchful eye on market shakers and movers. Catch the next episode of Sound Economies with Mel and Peter, a podcast by Longines Investor Insights. Available on Spotify, YouTube, and wherever you listen to podcasts. Longines Capital has been in the business of investment advisory and wealth management for over a decade, with our high-performing and multi-awarded funds to show for it. We're taking this to the next level through an IPO in 2 years. Join us in this journey. Visit our website to learn more.